Today, getting to grips with credit regulation, the international framework. Hello again, I'm Martin North from Digital Finance Analytics, and today we continue our series on credit regulation with Professor Gill North. Hello Gill, good to see you again.
Hello, nice to be here.
Great to see you. Now, we did an introductory video last week, which basically set the overall scene, and now we're going to do a deep dive into the international framework of credit regulation.
That's right. I'm not sure how deep it can be given the time that we have, but we are going to cover quite a lot of content.
Okay, well, content is good, so let's get started. Okay, so let's start right at the beginning with the question of what does the provision of credit and credit advice to consumers actually mean?
So when we're talking about the provision of credit, we mean the provision of loans to consumers, and that can include unsecured and secured loans and, for example, personal loans and home loans. When we're talking about credit advice, we mean the giving advice or assistance in relation to any of those types of loans.
So that could be mortgage broker.
That's right.
Could be within the bank or any combination thereof.
That's right.
Okay. So why is regulation around the provision of credit and credit advice necessary?
Well, the free marketeers would suggest that competition in markets is sufficient. And indeed, competition in consumer finance markets can enhance ultimate outcomes. But even in genuinely competitive finance markets, there are significant failures that arise. And these market failures can cause immense harm to the finance sector, to the economy, and to consumers. Now, when operating well, regulatory structures can mitigate some of these failures and can prevent others.
Okay, so you've used the term there, market failures. Perhaps we should make it real by giving a few examples.
So the failures that arise in consumer finance markets stem from imbalances of power, such as information, experience, and knowledge between lenders and borrowers. And these significant imbalances include the capacity to assess the risks of a loan, the allocation of the risks of a loan, available information on a loan, and behavioural biases.
Well, that's a good list to start with, isn't it? Maybe we should take each of those in turn and just go a little bit deeper, because I think if I think back to the Royal Commission, for example, these were precisely the issues that they were starting to touch on. So let's go through each of them in detail. Let's start with the differences in the capacity of the lender versus the borrower to understand the risks attached to a loan.
Well, the capacity of a household or a consumer to understand the risks of a loan and of their overall financial position is often limited due to poor literacy standard, a lack of experience, poor access to information, or access to information that's non-specific, irrelevant, or incomplete, or information that is not able to be used to compare available competing products. By contrast, lenders are in a much better position to be able to objectively assess credit risks and the risks of a particular loan, because they generally have large accumulated databases and experience of credit markets. And this allows more sophisticated and reliable assessments of a borrower's financial position and capacity to repay the loan.
Okay, so let's take the conversation a bit further then about the information that's attached to a loan.
Consumer finance markets and regulation often rely on disclosures, but of course the disclosures are only useful if consumers can actually understand them and act upon them. Some borrowers may feel rightly or wrongly that there's no point in reading these disclosures, either because they believe that they don't have access to other options or because they're not going to understand them.
So if I can just reinterpret that, there may be lots of bump out there for people to try and read, but unless it's actually communicating clearly and effectively, people may not read it, or they might read it and not understand it, or indeed it may be written in a way deliberate to obfuscate what's really going on.
Yeah, all of those things. And I mean, even you and I know as relatively sophisticated consumers how difficult it can be to use information that's provided in a way that's meaningful when we're trying to make decisions. And sometimes I just read it and think, oh, so what? How does that help me? And so you can imagine that for other consumers that don't have the time or capacity that we might have, it's really a very difficult environment. And so much these days is left to the consumers. And it's really not realistic for time and capacity reasons.
And quite often, of course, this information is just available on the web, and they say, go and have a look at it on the web.
Yes, yeah.
As though somehow that magically works.
Oh, that's right. More and more, the load is on the consumer to have to find the information in the first place. And even that in itself can be really quite difficult.
Okay. So let's take the conversation on a bit further, because not only is there the information, but there's also risk assessment, right? But the risk stuff is actually quite critical, right? But it's also about the allocation of risk.
Yes, I wonder sometimes how many consumers understand just how great the imbalances are in this area. So, for example, home loans are generally provided by lenders within a diversified portfolio, so that mitigates their risks. When they're providing home loans, often they will go on to securitise that, and that's another way for them to diversify and mitigate their risks. As many of you will be aware, home loans are generally secured on a property, and that can have a profound effect, because if the borrower defaults for any reason on their loan, then that allows the lender to ultimately sell the property to repay the loan and any other costs that may have been incurred. Lenders take further protection on the riskiest classes of loans, and they do that by requiring borrowers to pay lender's mortgage insurance. And those kinds of policies are paid by the borrower, but in fact protect the lender on a last resort basis. The proceeds, when they sell a property, are insufficient to repay the loan, then they can rely on that mortgage insurance policy.
What about car loans? What happens there?
So with car loans, that's another example where many lenders tend to mitigate their risk by taking security over the car. And that allows them to sell the car if the borrower cannot repay the loan. Even unsecured lenders seek to protect themselves. So, for example, many of you have probably heard of payday loans. With these payday loans, they're not secured, but the lenders protect themselves by getting borrowers to give them priority direct debit access. And this means that the lenders get immediate access when any new funds come into the account.
So in summary then, it sounds to me as though lenders have it always, right? So on secured lending, they'll take the mortgage on the property, which means that they can always foreclose on you if you fall over. Or if lender's mortgage insurance is there, it effectively means they've got additional protection too. If it's a car loan, they've got security over the car. If it's an unsecured loan, they'll actually have the ability to grab direct from your account to pay that unsecured loan, if it's a payday loan, for example. So in every case there, it's all in favour of the lender.
Each side should act to protect their own interests. That's the very nature of a commercial market. Consumers can, of course, try to protect themselves. They should ideally manage their financial position, and when times are good, put money aside, have buffers, pay off debt. They can also take forms of insurance that can protect them, for example, if they become disabled or they lose their income. But in reality, many consumers struggle to manage their finances.
And sometimes the easiest thing is just grab another loan, which of course then leads to problems later. Okay, so you've mentioned behavioural biases. Let me unpack that a bit more, because that's a concept that many people won't understand. So what do you mean by behavioural biases?
Well, this is an area that's receiving increasing attention. And when we're talking about credit, probably the most important behavioural bias is this tendency to be optimistic. When borrowers are taking on a loan, they often tend to forget to think about worst case scenarios and the unforeseen events that might happen both in their personal circumstances but also large external shocks. Now, for home loan borrowers, these optimistic tendencies are often reinforced by a very deep desire to want to own a home loan, to share in the upsides of investment markets, and are encouraged by powerful constituencies.
And it could be argued, I guess, that if the bank makes an assessment and says, oh yeah, fine, you can have the loan, then you've automatically going to switch into, well, if the bank says I can have the loan, then it must be the right thing to do.
Well, that's another danger of when things go wrong, there's going to be a lot of blame to share around, and we'll have the debate then to a much deeper extent as to who should bear responsibility for those decisions.
Okay, so we've got the idea then of there's a whole bunch of reasons why regulation perhaps is required. But in the context of market failures, this becomes ever more critical, doesn't it?
That's right. So given those market failures that we've just discussed, in most people's minds, effective regulatory structures and the supervision of those structures is really essential to prevent or to minimise harm to the finance sector, to the economy and to the community at large.
So basically, if we've got the right regulation in place, then the financial system itself, the players within the financial system, and indeed community and consumers can all benefit.
The onus on supervisors, particularly in the credit arena, is a heavy one for reasons that we'll discuss in a moment. But at the same time, I understand, and many others understand, that regulation can only play a role.
So let's go back to the GFC, right, and think about the regulation that was there, and particularly the market failure that was there. Was market failure effectively the trigger to the GFC?
Well, certainly market failures occurred during those periods leading up to the GFC. Many of the loans that were made were unaffordable, unsuitable and inappropriate, all of which reflect market failures.
Okay, so they were not affordable, not appropriate and not suitable for the borrowers. And you're talking here specifically the US, presumably, are you?
Yes, I think most people think of the US because that's where the crisis started. But countries such as Ireland were later exposed when it was shown that they also had major issues with the credit that had been provided. And other countries had property loan issues, but they weren't residential related, they were commercial.
So let's just take the GFC discussion a little further, because really it gives us a really good context then to think about how regulation may or may not need to be changed or has changed since then. So what triggered the GFC?
The initial triggers in the US were defaults on both home loans and on securitised products that were linked to those home loans. And when these defaults arose on those home loans and on the related products, the vulnerability of institutions and of the broader financial system were exposed. There was a whole series of losses through connected events in relation to significant declines in the pricing of houses, then rapid declines in the pricing of the securitised products that were sitting on the balance sheets of those financial institutions, and then major issues with access and the cost of credit finance.
And my understanding of the GFC, there were two really interesting triggers. The first one was the adjustable rate loans in the US, where effectively poor credit mortgage borrowers were given loans at initially very low interest rates, but with automatic accelerators later. And so the repayment costs rose and rose and rose and tipped them over. And the second one was that the securitization of those loans into other financial entities around the world meant that the risks were parceled up and passed on and passed on and passed on around the financial system to the point where nobody actually knew where the risks were hidden and whether you had a parcel of good loans or whether you had a parcel of bad loans. So in essence, it was poor lending practice, wrong product design, and the way that the financial system was able to try and manage those risks on through securitization that really laid the seeds then for all of the things that followed.
That is at the heart of it. I mean, there's been obviously a lot of debate around the causes of GFC, and there are a wide range of varying views about what was the key trigger. In my view, the lending on residential properties was at the heart of everything. And there was this belief that house prices would continue to go up, and the lending was made accordingly. We'll talk a little bit later about the mis-selling of those loans, because I agree that that was a critical component in the defaults arising.
Okay, and sidebar, Australia, please note, because we perhaps are replaying some of those same events here, maybe not exactly the same, but in terms of lending practice and in mortgages, there seem to be a lot of parallels.
I think there are. It's obviously a different set of circumstances, and our mortgages are not normally classified as being subprime, but many of the same principles do apply. And we certainly are beginning to hear more and more about the mis-selling of housing loans here. The equivalent to subprime mortgages here in Australia would be non-standard loans, such as loans that don't meet serviceability requirements, interest-only loans, investment loans, and so forth.
There's a bunch of consequences then that came from the GFC and the way that it sort of triggered. So what were the consequences?
The events I've explained and the ensuing damage spiralled, because what I discussed was really just the direct consequences, and the indirect consequences were far more devastating. So what I mean by that is the long-standing recessions in many countries and the issues within banks of bad loans that even today arguably have still not been completely addressed in some countries.
Right. So it was that spiralling, and of course there were some bailouts as part of that.
Much of the associated burden that was funded by national taxpayers and the broader community, and that was done in the form of bailouts. In some other countries it was nationalisation of financial entities. There was liquidity and funding support that was provided, but more importantly it led to restrictions in the credit market for quite some time, and perhaps the most important consequence of all was the reduced economic activity for a decade in some countries. So you can measure those indirect costs in different ways, but however you measure it, it was truly massive scale.
And it's worth saying that despite all of the hype and hiatus after that, and the upping the credit and everything, the credit ratios and things, almost no bankers anywhere went to prison for their poor behaviour. Right? It seemed to me that they almost got off scot-free, and it almost seems that the taxpayer ended up handing money across to the banking system to keep it afloat.
That's a big topic I'd like to deal with in a later video, because this is an area where people tend to make very sort of sweeping statements.
Like I just did.
Like you just did, yeah, yes. And I think one needs to provide a more nuanced answer, because again, I think you've got to get the balance right in blaming the regulators. And there's certainly a lot of blame that should go onto the regulators, and indeed I've written articles in that vein. But regulators can only enforce the legislation that exists. And yes, it's true that in many cases they didn't use the full armoury that was available to them, but it is very difficult to get criminal prosecutions. And so I do have some sympathy for the argument that yes, a lot more criminal prosecutions should have been made. That is not easy to do under the existing law when you're talking about trying to make the executives, the board of directors, accountable within finance corporations. Even today, after all of the reforms, that's still very difficult to do.
Okay. Well, I look forward to that later discussion, because I actually think the whole question of accountability and executive accountability inside corporations is really a critical question. It's perhaps one that the Banking Royal Commission will actually also be talking about here when they report later in the year.
Perhaps, yes.
So, Jill, what lessons about the provision of credit were identified post the GFC?
Well, I'd like to highlight three main lessons that I think ought to have been learnt. The first is in relation to the boom-bust nature of credit cycles. It's well known that these boom-bust credit cycles are often driven by lenders who want to keep increasing the amount of credit they're providing, because that's what drives business activity and, of course, profits. And when competing for that business, lenders are inevitably tempted to reduce their lending standards. This is not new. This is something that's been happening for many decades. So it's these cycles that point to the importance of strong supervision of both prudential and responsible lending standards, and that robust supervision is most critical during the boom times of credit cycles. The second lesson I think that's important is that many of the home loan borrowers, as we discussed a little bit earlier, that went into default were subjected to poor and even illegal lending practices. And as a result, many of these borrowers did not understand the terms or the implications of those loans that they'd been given. Many of them were subprime mortgages, and these were to people that came from the most poverty-stricken or disadvantaged communities in the United States. The level of loan defaults and foreclosures following the GFC was very high. And even today, some of these areas and households have not fully recovered. These events, I think, point to the importance of the Prudential Regulation of lenders and the Consumer Protection Regulation. That law to protect consumers is most important for the most vulnerable sections of the population. The third thing I'd like to point out, and we were talking about this earlier, is that individual regulators were often myopic, in other words, very narrow in their focus, and were deeply influenced by industry. And as a result of that myopic focus, supervisors failed to adequately understand the bigger picture issues and all the inherent interconnections and accumulating systemic risks. It's hard for one to point to examples where oversight of the rules was adequate and transparent. One might hope that supervisors in the post-GFC environment are more awake to these issues, and one might also hope that they've learnt that they need to communicate with one another and try to grapple more effectively with system-wide issues.
So those three things you've just called out, which is essentially the way lenders make lending decisions, the regulation around consumer protection and how much consumer protection is in place, and the role of regulators are, if you like, the three legs of the stool.
I agree. That's exactly how I would put it. It is the three legs of the stool, and you have to have all three of those legs operating.
Now, I find that fascinating because, of course, the Royal Commission in Australia has been touching on all of those three elements.
And rightly so. I think the trickiest bit, or the most challenging thing for the Royal Commission will be to provide recommendations to improve practice in all three areas.
So do you think the industry and regulators and, I guess, consumers and consumer bodies are now more aware of the issues compared with a decade ago?
Yeah, we're going to talk about this in a moment, but I think that most of the focus has been on financial stability and on the lender's position. And in my view, not enough emphasis has been made of the consumer protection leg and on the supervisory leg.
Okay, so that takes us nicely on then to the question of what credit reforms were made post the GFC.
Because of the residential lending issues in the United States and elsewhere, regulation regarding residential property lending standards and practices has been a key issue of both policymakers and supervisors since the GFC. As we've discussed, the credit reforms that have come in do include prudential regulation and consumer credit regulation to protect consumers.
Okay, well, Jill, that's really interesting. I'd like to take each of those a little bit deeper, I think. So let's talk about prudential regulation first.
So the primary rationale of prudential regulation is to ensure effective management of risk, both within individual financial institutions and across financial systems more broadly. So finance should support rather than disrupt the real economy, and it should not harm the communities that it seeks to serve.
So what you're talking about here is what some people have called the desire to achieve financial stability.
Yes, prudential regulation has been more narrowly framed as financial stability by many policymakers and supervisors over the last decade. And that has implications because I think prudential regulation is broader than financial stability.
Oh, okay, that's a really important point. So effectively, financial stability is a subset of prudential regulation. It doesn't encompass the whole of it.
That's my view, yes.
Right. There are probably some down APRA who say, oh, we've done financial stability, so we've done our job then.
Yes.
And what you'd say is, no, necessary but not sufficient.
Yes, and indeed the legislated objectives of APRA make that clear. But many of the problems are caused because of people's differences in what they mean by financial stability.
Okay, but let's just go down the financial stability route just a little bit further. So how do you promote financial stability?
Well, there are many definitions of financial stability, but one of the ones that I quite like is a state whereby the accumulation of systemic risk is prevented. That's how most people would define the promotion of financial stability.
So that basically means being alert ahead of the curve and reacting and responding to things before they get too serious, and effectively making course corrections early in the cycle.
It does mean that, but that's where I think most of the problems have arisen.
Right.
Because if you're preventing the accumulation, it is by its very nature a proactive approach.
Okay, and perhaps we could argue that in Australia more recently, there's been a very much sitting on the hands and then suddenly trying to react almost post-events.
I do argue that. I've just written an article on APRA, and that's exactly what I argue.
One of the things that financial stability talks about a lot is systemic risk. So what does that mean?
Systemic risk, I think, is complex. So systemic risk has been defined by one body as a risk of disruption to financial services that is caused by impairment to all or part of a financial system and has the potential to have serious negative consequences for the real economy. So I think systemic risk is more complex than that definition implies, because systemic risk can derive from multiple sources, including cumulative financial imbalances, large external shocks, contagion effects across institutions, intermediaries, infrastructure, and markets. So the management of financial stability includes both public and private participants in financial infrastructure, and that it includes the legal system and regulatory framework for credit regulation and surveillance.
So what you're really saying there is this is a complex set of interrelated things, right? And it's trying to understand how all of these components connect together to be able to actually look at it systemically and then to see where the risks across the system might actually be coming from.
Yeah, I mean, this is the most challenging component of the implementation of reforms in the wake of the GFC, because it was recognised that this was the area of risk that had been poorly understood prior to the GFC. And the question is whether it really is better understood now. So there are a lot of mechanisms in place that purport to identify and mitigate systemic risk. But my concern is that it's such a holistic concept that it's very hard for one regulator or one body to understand all the bigger picture issues. So it comes down to the ability and capacity to be able to communicate well.
So presumably the temptation is just to pick one or two elements within this broader picture and drill down on those and say, well, we fixed that bit at least.
And that's what I think is happening.
So, Gill, to what extent have the regulators then focused on the provision of financial stability post the GFC?
I think the word financial stability has become almost a buzzword, and there have been multiple bodies that have been set up in the wake of the GFC that are dealing with the promotion of financial stability. And the most important of these bodies is the Financial Stability Board that was set up in 2009. Importantly, the recommendations of the Financial Stability Board do not have legal standing. Instead, this body sets internationally agreed policies and sets minimum standards that member jurisdictions agree to implement at a national level. First, verification of customer income and other financial information. Secondly, reasonable debt service coverage. Thirdly, appropriate loan-to-value ratios. Fourthly, prudent use of mortgage insurance. And finally, effective supervisory tools and practices. And these combined elements are intended to work together to produce sound mortgage underwriting standards and practices.
But the FSB has no legal authority. So how do those get translated then into something which is actionable?
The FSB tries to reinforce the power of this principle-based framework by establishment of periodic reviews of each individual country. And these reviews consider and assess the lending standards and practices within the country, its regulatory frameworks, and possible gaps and weaknesses that need to be addressed. And then that's further enhanced by the publication of the reports, because that draws attention to any progress that has been made or otherwise.
So that sounds to me as though it's very much putting all the onus on the lender in terms of lending assessments vis-a-vis, say, mortgages. But what about the consumer? Don't they have some responsibility as well?
That's a great question that I and many others continue to mull over. It is and always will be important for consumers to take some degree of responsibility for their own credit and other financial decisions. However, the regulatory system should take into account the market failures that occur in credit markets. Interestingly, a report from the Financial Stability Board confirms that consumer protection is not about protecting consumers from poor decisions, but instead it's about enabling consumers to make well-informed decisions in a market that's free from abuse and deception. And I think that's a good starting point for this debate.
And did they have anything specific to say about the way that home loans might be missold?
Because the report does highlight the risks of mis-selling to consumers, especially when there are sales targets or remuneration that is linked to sales volume, because these practices increase the risk of selling home loans to consumers who are unable to repay the loan.
So in summary then, the FSBR is very clear that there are obligations on behalf of consumers.
Yes,
There are obligations on behalf of lenders,
yes,
but actually you need both ends to work well. And by doing that, you effectively can get around the moral hazard, which is effectively nobody takes accountability for the bad decisions that are taken.
yeah. So the longer I look at credit regulation, the more I think how important it is to manage it holistically. And I'm concerned that when you have regulators that are split with divided responsibilities between prudential regulation and consumer protection regulation, that the piece in the middle, all those grey areas, tend to be forgotten about.
Okay, so in a future video, we're going to take this a little bit further in an Australian context.
Yes.
But before we finish this one, let's just look at the consumer credit reforms. In other words, not the home lending ones, but the other lending for consumer purposes. What's happening there?
So the consumer protection rules that have been brought out in member jurisdictions are quite diverse. So they might include industry codes of conduct, regulatory requirements such as suitability assessments by the lenders, mandated disclosure, in more extreme cases, product intervention, that's starting to occur in Australia, and complaints and dispute resolution schemes.
So we talked about the FSB and what they're doing, and clearly there are also supervisory bodies within national entities as well. But what are the challenges then that they're wrestling with?
There's many challenges. Firstly, as we've already discussed, to maintain a proactive supervisory stance during the boom phases of the credit cycles. That's very difficult to do. Secondly, to prepare the country for the next financial crisis. That's also very difficult to do. To remain independent, to avoid regulatory capture, and to holistically manage credit cycles from both the lender and borrower perspective. Of course, it's not easy for regulators to remain independent and to call out poor lending standards and practices. As Jane Diplock, the prior head of the International Organisation of Securities Commission, said in the wake of the GFC, when everybody's making money and there's exuberance in the market, it's extremely difficult to be Jeremiah and say, look, you're about to go over a cliff.
So that's significant, right? Because what she's basically saying is that nobody wants to hear the bad news when everything's going really well.
No, because everybody's benefit. So the governments are benefiting by increased economic activity, so that looks good from their perspective. The regulators look all right during the boom times because, again, things are going well and they can point and say, yes, the standards are fine, and it's very difficult to disprove that. The banks are doing well because they're making profits, so their shareholders are very happy. And so it's the question of long-term consequences that can be forgotten in this kind of environment.
Well, I always say regulators need to lean into the wind. In other words, be thinking about the opposite of what everybody else is thinking, because by definition, at some point, the tide could turn.
But that's exceptionally difficult to do, and we'll talk about that some more.
Okay. So how would you rate the performance then of the credit supervisors?
So that's a very big question that we can't fully deal with today, but it's probably fairly obvious by now that I'm rather sceptical about the performance since the GFC. Many finance supervisors are arguably in the same grooves as they were in prior to the GFC. And what I mean by that is that their focuses are still too narrow. They're still heavily influenced by industry. Many remain reluctant to use their available power. And the system-wide collaboration and communication is poor. And perhaps the most important element of those is the final one, is the communication across the system. Although I recognise that there are some regulators who've worked quite hard to supervise and enforce the existing regulation.
And people have been talking about regulatory capture in the context of APRA and ASIC in particular. So what's that?
So regulatory capture occurs when participants exert influence over regulators to an extent whereby the regulatory decisions that are being made are in the interest of industry rather than in the national interest. And the potential for regulatory capture in the finance sector is acute. And that's because of the size and power of the largest financial institutions, which today is at an unprecedented level. The resources and power of these corporations allow them to actively lobby and influence the supervisory processes, as well as the broader policy debates.
Okay, so we've covered a lot of ground today, right? Because we've looked effectively at the definitional side of things, we've looked at some of the history, we've looked at both the lending around home loans as well as consumer finance and the role of the regulators. So in our next video, we're going to talk about what?
We're going to be talking about the responsible lending rules in Australia. I am going to come back to the international context at a later stage when we'll look at reforms more broadly, not just restricted to credit reforms, but reforms in the finance sector in the wake of the GFC. So we'll look at things like the capital adequacy rules, responsible lending, the systemically important financial institutions framework. So for those of you who are interested in this broader context, we'll look at that later. But in the next few videos, we are going to home in on the rules in Australia.
Good. Gill, well, thank you very much for your time today. It's been very interesting, and what you've shown to me is it's way more complex perhaps than I thought it was in terms of trying to navigate all of these components. So I look forward to another conversation shortly.
Thank you.
So there you have it. I think a really interesting perspective in terms of how to think about the regulation of the credit markets in particular. And check back next time for the next instalment. I'm Martin North from Digital Finance Analytics. Thanks for watching, and we'll see you next time.